Hello, everyone. Good morning, good afternoon, good evening, wherever you're watching this webinar from. I hope you're having a great day and all is well. My name is Corey Daharsh. I'm with Advanta IRA, and I'm here to bring you Real Estate 101, the basics of retirement account investing in real estate assets. Again, my name is Corey Daharsh. I've been with Advanta since 2016. I've actually obtained what's known as a CISP or Certified IRA Service Professional designation in 2018. And I've kept that up with continuing education. And throughout my time at Advanta, I've helped clients with thousands of different retirement account investments, ranging from anything as in a small hard money loan to multi-million-dollar real estate deals. I've got all my contact information here on this slide, and I'll also be happy to share it again. It's actually the final slide of the presentation, so if you are looking to take down my phone number, email, or my social media channels, I will have this up in front of you again towards the end of the presentation. Just a little bit about Advanta IRA as a company. We've been around about 20 years in this industry. As of right now, we've got just under 10,000 active clients and about $2 billion in assets under management. All of the funds our clients have with us that are not actively invested are insured up to FDIC applicable limits. And one thing we do, aside from these educational components, to stand ourselves above and beyond other companies in this industry, is that we pair each client with a dedicated client account manager that serves as the one-to-one concierge style liaison for each of our clients, so that they're not calling into a call center and having to explain who they are and what they want to accomplish each time they reach out to their custodian. They get one person that gets familiar with them and they get familiar with, that helps throughout the entirety of their account with any questions, concerns, rules and regulation issues, or processing investment transactions when you're ready. As I just mentioned, we do a lot of educational content. This webinar is one of a series that we try to put out 2 every week. We also have guests in a lot of our webinars that are experts in their subject field of industry. We have a video library of all of these webinars on our YouTube channel. And if we're in your local area, which would be the Atlanta area, Central Florida in the Tampa Clearwater area, and myself up in Western North Carolina, we may be putting on an actual in-person lunch and learn or seminar that you can attend in person. So feel free to check out our website, our events tab. We also have a blog, so if you're interested in industry news and information, you can go to our website and sign up for our blog to see that type of content as well. Now, before I get into the main portion of this webinar, I do want to disclose that we do not provide any tax, legal, or financial advice at Advanta IRA. We are experts in what the IRS will or will not allow within your retirement account, but we do all of this type of webinar and content for educational purposes only, and we always implore you to consult your own CPAs, attorneys, tax advisors, and financial advisors before you make any investment. So always do your own due diligence. We are simply a alternative asset, self-direct IRA and solo 401k administrator. Now, what is a self-directed IRA? Well, a self-directed IRA is a retirement account that truly gives you the power to make your own investment decisions. You may be familiar with an IRA at a larger wirehouse custodian that says they have a self-direct product, but when you look into it further, you're specifically limited to stocks, bonds, or mutual funds that they have done due diligence on, and with their fiduciary responsibility will allow you to invest into. A true self-directed account only restricts you from investing in things that the IRS will not allow, and aside from those rules and regulations, allow you to invest into anything you would like. I'll get into those IRS rules and regulations in a few slides, but just the rest of this slide here is just displaying a few different asset classes that we see our clients invest into. Obviously, if you're here for Real Estate 101 webinar, you're familiar with real estate being an asset class, but also mortgages and notes or paper assets, private placement investments. There are some precious metals you can invest into, foreign currency, futures and Forex trading, and cryptocurrency, and much, much more. If you've not heard about self-directed IRA accounts, don't be alarmed. That is pretty common. only about 4% of the retirement accounts in the US are self-directed. And to put that into a larger perspective, as of Q1 of this year, 2022, there was about $37 trillion in the US-based retirement industry. So of that 37 trillion, only 4% is currently being self-directed. So you're looking at a vast minority of people taking advantage of these unique investment opportunities and a more broad range of investments that you can truly hold in your retirement account if you just knew about these options and availabilities to you. So there are a lot of different types of plans that can be self-directed. Most of you are probably familiar with your traditional and Roth IRA. Those are usually the standard plans and 401k plans that you may have with an employer. But if you're a small business owner or self-employed individual, you could also consider a SEP, a simple or a solo 401k plan. And you can also have a health savings account or education savings account be self-directed as well. So if you're someone with a high deductible health policy, or you've got children that you're looking to save up for their educational expenses, you can actually use those types of accounts for self-directed investing as well. And why do people self-direct? Well, the key items or reasons that we see people starting to self-direct is that they're already doing some sort of investing to generate passive income, and they realize that they can create more investments and use their retirement account as a new source of capital. A lot of people at this point are getting fatigued with the stock market fluctuation and just seeing kind of a never-ending roller coaster on their stock market, stocks, bonds, and mutual funds assets. So they're either diversifying or maybe sometimes pulling completely out of those assets. And then also the tax benefit of making investments with a retirement account. Your income is growing at a tax-free basis that could either be tax deferred, meaning that you pay taxes when you distribute it later in life and in retirement, or completely tax-free if you have a Roth account set up, whether it's a Roth IRA or a Roth component 401k account. Now, there's a common misnomer about getting money into a self-directed plan, and I'd like to expel that right now. It's very easy to move money out of a managed retirement account into a self-direct account, and usually there is no tax consequence for doing so. The only real context where a tax consequence would apply is if you're actually doing a Roth conversion by choice, paying taxes on the money that you have in the account, converting it to Roth so that it can grow completely tax-free from that point on. But aside from that specific aspect, moving money via a custodian to custodian transfer, meaning an IRA at another custodian to a self-direct IRA, is a completely tax-free, non-reportable event. You submit one form to us, we submit that to your previous custodian, and we usually facilitate the movement of money within about 5 to 10 business days. The other option, if you have a previous employer plan or a different type of plan than you're moving into at the self-direct custodian, that's initiated usually via a direct rollover, where you actually initiate a distribution request with the current plan and a rollover certification form with the self-direct custodian. There is some taxable reporting in this case with a rollover, but that is basically a non-taxable event as long as the same amount you take out of the first qualified plan is rolled into the new qualified plan at the self-direct custodian within the allotted 60-day time frame. And just to further reiterate that 60 days is from constructive receipt, meaning the day you actually have the funds in your mailbox in a check or in your bank account, you have 60 days from then to roll it over into another qualified plan to avoid any taxable consequence. Now, I referenced earlier that you can invest into pretty much anything along with the IRS rules and regulations, so I've got some of that information here for you all. The only things that the IRS prohibits from an investment standpoint is life insurance policies and collectibles like antiques, artwork, fine wine or alcohol, stamps, pretty much anything that the IRS would consider a subjective valuation is not allowed to be held in a retirement account. And also, most current currencies are not allowed to be held in retirement accounts either. There are some coins, as I referenced on the previous slide, talking about asset classes, and other currencies that are not in active circulation that you could invest into. And if you're interested in that, we've done a lot of other educational content and have a lot of information on our website about precious metal investing. So feel free to reach out to me directly or check our website or our YouTube channel for any other content specific to those options. I do see someone just posted a question, and that actually reminds me. Thank you very much for using that question box. The recording of this session will be made available. It's typically posted to our YouTube channel within a day or two. As of right now, our office is actually closed because the office was in the path of Hurricane Ian down in Florida. But as soon as we are able to get electricity and power back in the office and our staff back in the office, we will get this webinar recording posted to our YouTube channel, and it will actually also be emailed out to anyone that has signed up for this webinar. So if you're attending live right now, you should get a recording of it within a few days. Just give us a little bit of patience based on the natural disaster and the hurricane that's been going through Florida. And I hope everyone, if you are located in that area, is doing well and safe. For those of you that are not, we're just affected by that right now. It's an unfortunate circumstance, but we will get this posted as soon as we possibly can. And furthermore, if you haven't found it yet, there is a question box in the GoToWebinar tab that you should have up on your screen. If you have any questions while I'm going, I've got that box in front of me so I can see it. I will answer your questions as they relate to my slides and my topics. And if they don't relate, I may hold them to the end, but I will try to answer everything that you guys post. So getting back on track with the prohibited investments and prohibited transactions, aside from the investments I just outlined, the only other thing that the IRS really does to restrict what you can or cannot invest into is limit people that are in your family, known as disqualified persons, from doing transaction deals with you. Now, you are allowed to partner with disqualified persons, but you're not allowed to do a deal with them, as in buy a piece of property from a disqualified person or let a disqualified person rent a property that you own in your retirement account. Those are really the only restrictions. I will get into disqualified persons a little bit more in depth on the next slide, but before I do so, I've also got this item on the right here, UBIT and UDFI tax. Those are some uncommon taxes that may apply to certain investments you're making. Unrelated business income tax really applies when your retirement account is generating a little bit more than passive income that could apply for those types of investments. And unrelated debt financed income is a special tax that applies when you're actually using your IRA to leverage a piece of property, meaning your retirement account is actually the borrower of a mortgage to secure a piece of property. So with those two, you're typically knowing about them as you're going into investment strategies that they would apply to. So part of your own due diligence is that you've probably already spoken with a CPA or a tax preparer that can help you accommodate those types of things. We're also experts in that too. So as you're discussing with us what you plan to invest into, we'll bring those up if they may apply. Now, as I just promised, the disqualified persons rules are pretty much any lineal descendants or ascendants, yourself as an individual and your spouse. I referenced the self to keep in mind that self-directed IRA accounts are something that you're controlling all the investments of, but yourself as an individual is a completely different entity than your retirement account that you hold yourself. So if you own a piece of property, you cannot necessarily code that into your retirement account with a quitclaim deed or sell it to your retirement account. It has to be completely separate from yourself, your spouse, your parents, your children, your grandparents, your children's children, pretty much anyone up and down that main branch of your family tree. See, another question came in. Can you lend money to an LLC managed by a family member? Well, there are some restrictions there in regards to these disqualified persons rules. If that LLC is 50% or more controlled or managed or owned by a disqualified person, then no, you should not be lending money to that LLC. Now, if it's a cousin, a brother, or an extended relative that is not on this disqualified persons list, then in theory, that loan would be okay. So here's a few examples of prohibited transactions. I know these past few slides I covered what the actual rules and the information are, but just to apply those to actual scenarios, your IRA cannot purchase real estate from your son, and your father's IRA can't lend money to you or your son. Your IRA can purchase real estate, but it cannot hire your son or his company to perform any of the rehab work if you're trying to do a fix and flip project. There's a few others here. I don't feel that I need to read off every single one. I think most of you probably get the gist of it by now. And again, we're here as experts in what these rules are. So as you're working with Advanta to make an investment, talk through your strategy with us. Talk through with your client account manager what you're planning to accomplish so that they can help you assess any potential qualified transaction issues or any other potential pitfalls or things that you may want to be aware of, just in case you may not be at the time you're starting to prospect and do your due diligence on your investment strategy. Now, as I reference due diligence, it's always imperative to find the deals and invest with people you know. So part of that due diligence is using your network. If you guys are a part of our network, we've got these great educational items. We also have a bi-weekly networking call that you can meet people and learn about investments they have to offer or promote what investments you're looking for as to network and find people. I'll bring up that event later on at the end of the webinar as well. But also, if it's real estate that you're interested in specifically, check out your local RIA group. Find other groups on Meetup in your area of real estate investors and start networking there so that you can build a network and you're not looking for your real estate deal with complete strangers and having to do due diligence from scratch on these types of deals that you're looking to get into. So when we're talking about real estate assets, there are a number of different asset classes and options that you can choose from. So it's not just specifically buying a piece of real estate, buying 123 Main Street. You can own a single family home for a rental or a fix and flip project, as I referenced a few slides back. You can joint venture on a project. So maybe you buy the dirt and the land and you joint venture with a contractor who's going to build on that property. And then you guys split the sale proceeds when that property is sold later on. Option contracts and wholesaling are things that you could do in a retirement account. Tax deed and lien investing is a great strategy for those of you that may just be starting out with your retirement account, don't have a huge balance to actually take down a piece of property, or may not be interested in using your retirement account to finance property. We've done some great content on tax deed and lien investing with a few experts that are in that field, and really great resources and great people to network with and to build a relationship with if that's a strategy you're interested in. And then syndication investing, where you're a limited partner and you're just really putting up your money. Someone else is doing all the work as the general partner on that property or that investment. And then you're just taking in mailbox money, for lack of a better term, money that comes back into your retirement account based on what you put up. Or being a lender, you can always lend either an unsecured or a secured note on a piece of real estate. So if you know a flipper that needs more capital, you could use your retirement account to help them out as well. So more detail in another slide on asset classes specifically. You can look at single family homes for long-term, short-term, or rehab projects. Condominiums, very similar to the single family home case for long-term, short-term rehab projects. Physical mobile home units or an entire mobile home park or community can be held in a retirement account. Real estate investment trusts are often used and set up for retirement account investors. And then syndications or private placements, whether it be for a commercial property, multifamily properties, or other types of syndications or private placement investments that deal with real estate, again, where you're just signing a subscription agreement, you're sending out money from your retirement account, and then you're usually getting a dividend back and potentially a balloon note when the deal is paid off or finalized, bringing back all the principal that you've sent out for that transaction. So when we're talking about buying real estate for any specific purpose like rentals, flipping, raw land, or anything else, you're talking about buying real estate in the retirement account, 123 Main Street, parcel XYZ in whatever county you may be located in or looking to invest into. It's important to note that you're buying the property in the name of your retirement account. So that deal is done and the deed on file that gets recorded through that closing transaction is in the name of your retirement account through the tax ID number associated with the retirement account. not yourself personally, and not your personal tax ID number. All the funds from that purchase do need to come out of the retirement account, and all of the purchases made need to be done with the balance of that retirement account, unless you're partnering, at which point you would actually do an ownership percentage breakdown. And I've got a case study in a little bit more detail to go over that later. But all the income comes back into the retirement account as well, tax-free. You may have to pay taxes later on as you distribute it out of a traditional account, which is a tax-deferred class account. But if it's a Roth account, you never pay taxes on the income generated from either the rent, the sale of the property, or anything else that has to do with that real estate asset. When you're paying bills for a property owned in your retirement account, most clients end up doing that through our online bill pay system. So you will have a client portal as a Advanta IRA client that you can log into and submit any payment that needs to be processed. We typically process those within the same business day or the next business day, depending on what time of day you get that payment request over to us. Or you could employ a property manager. A lot of clients choose to do that. That is a case by case and discretionary objective there. So just keep in mind that you may be paying that property manager a percentage of the proceeds and the profits to manage the property, whereas you could otherwise pretty much self-manage the property through your Advanta account, utilizing Advanta to take in the income from the property, pay out the expenses of the property. But again, you submit the invoice to us or the payment request in your online portal or with an email to your client account manager. We process everything typically within one business day. We could send out wires, ACH transactions, or cut a check and mail a check from our main office. When you're managing the property, it's important to note who can and cannot do repairs and maintenance. So the IRA owner cannot perform any services on the property as simple as painting, changing a light bulb, doing anything. The IRA account holder is again a disqualified person from doing any of that sweat equity or labor. Also, other disqualified persons like your siblings are not allowed to do so. I'm sorry, siblings are not disqualified persons. I meant to say spouse, children, parents. Who can do the work is any non-disqualified person or relative. The IRA owner can inspect that work, but they cannot do any sweat equity or really kind of be on site and helping in any capacity. And there's no guideline as to the qualification of the individual performing the work. So you do not have to go get a certified plumber or anything like that if you don't choose to. It can be your standard handyman up the road or someone that you know that's good at whatever service you need done. They don't have to be a certified or specifically licensed individual. There's no rule regarding that at this point in time. So as you have a property and you're looking to rent it, you as the IRA owner actually select and qualify whoever you plan to rent the property to. Having said that, you do need to send the lease agreement made out between the retirement account specifically and the renter, leasee, whoever it may be, to Advanta. You'll mark it as read and approved so that we've collected your authorization before we execute it from the property side of it, and you'll make sure that it's signed by whoever you're looking to rent the property out to. But again, you negotiate all the terms. It's completely up to you to decide on those terms and come to an agreement with whoever you're planning to do the business with. You would name the contract in the name of the retirement account, again, because the retirement account technically owns the property as of the deed of file with the county that it's located in. And you could also employ a property manager, again, to do this type of thing. If you choose to do so, just keep in mind, they're going to charge a percentage and or a flat rate for doing these types of services. So now we're going to jump into case studies. I've actually got 4 case studies on today's webinar. The first case study here is going to be purchasing rental real estate. Then I think I have a case study on purchasing and partnering for real estate. Then a case study on syndication investing. And finally, I'll wrap up with a case study on using an LLC, typically known as a single member LLC or a checkbook IRA strategy that can do any of these types of investments and give you a little bit more control of the retirement account funds and day-to-day maintenance, maintaining the property, maintaining your retirement account cash as well. So jumping directly into case study 1, I've got a scenario here where John is an investor. He decides he wants to pull some money out of his previous employer 401k plan to purchase a rental property down the street from his house. So he opens and funds an account with Advanta IRA. He finds an investment property. In this case, it's valued at $100,000. He makes an offer to purchase the property, submits the paperwork to Advanta to follow through and authorize us to do that transaction on behalf of his retirement account. And we also make sure we collect read and approved documents, all of the documents required at the closing table from John. And then we work directly with the closing agent and the closing company to process the transaction in the name of John's retirement account. We execute all the documents on behalf of the retirement account, send the funds out to the closing table, and then once the deed is recorded, we hold the original and all copies of the executed paperwork in our safekeeping vaults, just so that we have documentation of the asset that we're holding, owned by the retirement account we're custodian and administering. In this case scenario, we also receive all the income and pay all the expenses for that property. So John, in this case, does not set up a property manager, but it is an option he could do so if he wants that to be a separate part of this investment strategy. So as this scenario plays out, the property is rented at $1,000 a month for 2 years. John sells the property after those 2 years for $150,000. So he makes a $50,000 profit on the original $100,000 purchase price and $24,000 profit on the rental income he generated. No taxes are paid on that $74,000 of profits realized in this investment strategy. So now from the initial $1,000 investment, $100,000 investment John had made, he has $174,000 to roll into his next investment, or investments plural, if he chooses to take that and break it up into more than one property or more than one asset class. Or he could just buy one property now valued about 75% higher than the initial property was. So in case study 2, we're going to take a very similar scenario, but actually do so with more than one investor being involved in the deal. So in this case, I have Paul and Linda. They decide they want to partner on real estate. Linda and Paul find a deal. They each have $100,000 in their retirement accounts. They find a property valued at $150,000 that also will need $20,000 in repair values to get it ready to rent. They estimate that this property is going to yield $1,500 a month in rent that will go into their retirement accounts. So structurally speaking, Paul and Linda open up self-directed retirement accounts. They found the property. They make the offer to purchase the property in the name of their retirement accounts and work with Advanta to submit the Advanta required forms to process the transaction and read and approve all the documents authorizing Advanta to execute the transaction on behalf of their respective retirement accounts. Advanta IRA works directly with the agent, that's the client account manager in this scenario, to process the transaction, execute all documents, and sign everything on behalf of these two retirement accounts, wire out the money, and then receive all the income, pay out all the expenses that are due for the rehab work and the rental property moving forward. So as it relates to this strategy where Paul and Linda are co-investing, the deed has to be titled as tenants in common between the two IRA accounts. And if you're looking at the way the deed's actually written up, it typically looks something like displayed here. Advanta IRA for the benefit of Paul's IRA number as to whatever percentage ownership he's going to hold. In this case, I've got it set at 50-50. Undivided interest, and then the other retirement account, so Advanta IRA FBO Linda's retirement account, as to whatever percent, in this case 50, undivided interest. It can be broken up 10%, 90%, 1%, 99%. It could have 3 members, 5 members, 7 members. It really is limitless how you split this deal up. And again, keep in mind, you can partner with disqualified persons that I referenced earlier as a prohibited item, as long as you're on the same side of the deal. So going into a purchase together, not purchasing from one another. So in this case, I've got Paul and Linda as separate retirement account holders, but just think about it in theory. This could be Paul's retirement account and Paul as an individual using savings that he has aside from his retirement account partnering on the deal, or Paul and his father or his father's retirement account. Those are just different strategies that you can do when you're partnering with real estate investments. The percentage is always going to be directly tied to the closing cost and directly built out by what is coming to the closing table. So in this case, 50-50, it was a $150,000 property. So we can assume that Paul and Linda are both putting up $75,000 at the closing transaction. Each IRA will share the income and the expenses based on that ownership percentage. And it's important to keep in mind that you cannot buy each other out later on, specifically if you're disqualified persons. So if Paul and Linda decide one of them doesn't want to be in the deal anymore, as long as they're not disqualified persons, they can basically buy out the other. But if they are disqualified persons, like I just referenced, there's no way for Paul to use his IRA account to buy his father's IRA account out of the purchase, or his father as an individual, or even Paul himself can't use his retirement account to buy out the rest of that ownership. So my third case study here is investing into a syndication. Again, this is a deal where you're not doing anything besides being a limited partner, a silent partner, if you will, into a larger project that has general partners that are actually handling the day-to-day maintenance and the ongoing activity of the investment. So when you're investing into a syndication, we've got a syndicator and an investor. So Larry has over $50,000 in an IRA with a larger custodian, Vanguard in this case, and he meets Malcolm, who is a syndicator or a capital raiser, is often referred to as well, who's trying to purchase a local apartment building. So Malcolm provides Larry the full subscription document and prospectus, and the minimum investment is $50,000, which is commonplace in syndication investing. You may find some that are a little bit lower or a little bit higher, but just as a general example here, I've got a $50,000 minimum investment. Larry reads over everything, does his due diligence on Malcolm and his team and his group, and decides he does want to move forward with this investment. So Larry opens up a self-direct account with Advanta, transfers money from Vanguard. Again, that transfer process just entails filling out an Advanta transfer request form. We submit that on his behalf over to Vanguard, and we typically see that money come back into the Advanta account within about a week's time. And he also submits subscription documents as read and approved, along with the Advanta IRA required documents to direct us to fund the investment transaction, all in the name of his retirement account, not himself personally, and with the tax ID number from his retirement account, not himself personally, for the transaction. Once we receive that, we execute the paperwork, send back Malcolm the signed investment paperwork, send the wire over to Malcolm's team, or cut a check and mail the check, whatever the investment describes specifically in that scenario. And then moving forward, the deal pays an 8% preferred distribution to all subscribers. So Larry's IRA receives $4,000 each year that the deal is active. And then in year 5, the project's refinanced, which is also common in syndication investing. And Larry's IRA receives a lump sum payout of $65,000 as the final payout. So Larry's IRA has earned $20,000 in yearly preferred distributions, so that's $4,000 over a course of 5 years, plus a $15,000 profit on top of his initial $50,000 investment at the onset, generating $35,000 in profits specifically out of this investment transaction. Got another question here. Can an individual invest in a syndication managed by a disqualified person? In other words, a father investing into a son syndication. That does fall in line with the previous question about lending money to a managed LLC by a family member. There is some gray area involved with that, but typically the answer would be no with a specific disqualified person. If the disqualified person is in the general partner team, but not necessarily owning the deal at a 50% or more threshold or making the day-to-day decisions for the syndication, it may be allowed. That'd be something really on a case-by-case basis. We would speak with you, ask a bunch of questions to just determine from our side where that situation may lie. And we may potentially, again, we don't provide tax, legal, or financial advice, implore you to seek your own legal counsel to be sure if that deal is allowed or not per their legal guidance and discretion. So great question. It's one that does come up a lot, and really there's no hard and fast answer there. It would probably be a case-by-case basis to determine if that strategy will work for that specific deal based on the involvement of the individuals. So in my final case study, I'm going to describe how to make any of those transactions I just went through in case study 1 through 3 using what's known as a checkbook control IRA or a checkbook LLC, also known as a single member LLC. This in itself is an investment strategy that a lot of people utilize, again, to get more control of their retirement account money. In this case, you set up an LLC entity that is wholly owned by your retirement account, where you are the manager, and we actually move the money in our transaction between the retirement account and Advanta IRA as the custodian to a bank account that you have access and control of, hence checkbook control. This strategy in itself is something we've covered in itself in depth in our website, as well as on other webinars that we've put out. I recently did one on how to set up and maintain a checkbook control LLC, but this is just a simple case study for the purpose of real estate investors specifically. So we've got Joe who decides he wants to do investments through an LLC. So he opens an account with Advanta, transfers or rollovers funds, gets an account number issued, and at that point goes and sets up the LLC at his discretion. He can also use an attorney or a CPA that's familiar with this type of investing. We do have a few that we could refer to our client base if you did want to invest in this strategy but just didn't know how to get started or set up the LLC yourself. They do charge a fee for doing that. Anyone that you go to from a legal or tax perspective looking to set it up is going to charge a fee for that, but you could also otherwise do it yourself. So getting the LLC registered in the state of your choice, getting a tax ID number from the IRS for the LLC, and also preparing and providing an operating agreement that has a few specifications for the checkbook control purpose that we outline to you in an instruction email and we discuss with you in depth as a client account manager as you're getting set up for this strategy. So Joe's LLC must be drafted, provided to Advanta, along with 2 simple Advanta forms directing us to fund his retirement account into an investment of the LLC itself. I see another question come in. What interest rate is received on the money held in account with Advanta? That's a great question, and there is no interest rate. If you've got active funds that you're not currently investing with Advanta, that money sits in what's known as a basic trust account, bearing no interest. So if you are an investor that plans to make some deals and have some money sit on the sideline, just be aware that that investment money is sitting in an undirected fund status, not bearing any interest, waiting for your next transaction to come up. So as a rule of thumb, you could definitely leave that here, but that is your discretion. Or you could move over specifically enough to cover the investment you'd like to make and maybe cover a few years or a few quarters worth of fees due to Advanta if you're deciding to have the fees that we assess billed out of your account balance. Otherwise, again, leave that money in an account elsewhere that may be getting invested or earning some interest as you're waiting for your next alternative investment deal to come to the table. So once the LLC is set up and funded, basically the setup process is Joe turning in the Advanta purchase documents and the operating agreement, Advanta executing that operating agreement and processing the purchase documents on behalf of the retirement account, sending the money out to the bank account that Joe has established in the name of the LLC at whatever financial institution he chooses. Again, we do have some financial institutions that we could refer you to that are familiar and have helped with checkbook control clients. You could also use whatever institution you choose. That's completely your discretion. And moving forward, that money's in a bank account that Joe has a checkbook for or a basic debit card that he can go make his transactions. Again, with this strategy, we are not overseeing all the inflow and outflow of cash or the transactions Joe is specifically making in the LLC. So it's important that he understands the rules and regulations of retirement account investing. He will always have Advanta as a resource to come back and speak about his investment goals or strategies with and go over concerns he may have. But there is a little bit more freedom with checkbook control and also a little bit more onus and responsibility to not engage in any prohibited transactions or prohibited behaviors, because if he were ever audited in the future, that could come back as a prohibited item and be a big headache and a problem at that point in time if it were ever determined. So things to remember about checkbook control. Specifically, checkbook IRAs are an IRA that is owned 100% by the retirement account and managed by either the retirement account holder or someone that they trust and appoint as the manager of the LLC. You can have multiple managers, so maybe yourself and your spouse are a manager, or yourself and a business partner are the managers. You could also set up an LLC with multiple members, very similar to partnering on real estate. You could partner into an LLC, but it does not necessarily hold the same as a checkbook IRA or a single member LLC when you have multiple members in it. But it is still allowable, and it is a very similarly related investment strategy. If you're interested to learn more about the pros and cons of multi-member or single member LLCs, that's the type of thing you would have the conversation with your account manager or myself at the onboarding phase, just to discuss what your goals are, what your scenario is, and how that would work out. And then with any property purchased or syndications processed through an LLC, that checkbook control takes in all the money, pays out all the expenses directly through that LLC's bank account. You have no obligation or requirement to send any funds back to Advanta until you either want to use them in a completely different transaction, maybe move them back to another retirement account custodian to invest into stocks, bonds, and mutual funds, or take a personal distribution of any of the money. Very, very important to note, you should not be taking any personal use or access of this money when it's in the LLC. You're serving as the manager, so it's your responsibility to only use the LLC and its funds for IRA related investments and transactions. If you want to take a distribution of any of the profits or proceeds earned in that account, it does need to be sent back to Advanta so that we can follow the proper protocols for issuing a distribution to you. And just real quick, the final bullet point here, if you're hearing this strategy and are concerned about the IRS rule and regulation of being the manager of your own retirement account or having direct access to your retirement account money, there is case law that does support that you're allowed to do so. I'm not going to get into the very specific niche of these case study and case law, but Swanson versus Commissioner back in 1996 was a tax court situation where it was ruled that Mr. Swanson was allowed to serve as the manager of his IRA LLC. Specifically, you're not allowed to pay yourself a salary or commission, so you are being this manager free of cost and free of expense, but you're able to do so to benefit your retirement account, which is your future earnings and your future benefits. So that is the inherent benefit of doing so, while you are foregoing the ability to earn a salary or an income based on your role as that manager. And then the T. Ellis memo, the tax court memo from 2013, also kind of just reiterates and supports that checkbook control is an allowable strategy. We have gone into both of those in more depth in other webinars and or on our website. But again, if you have specific interests or want to research those further, please feel free to do so as part of your due diligence or have that conversation with us offline off of this webinar with your Advanta account manager or myself on the business development and onboarding side as you're getting set up and started. So for the most part, that does wrap up our webinar today. I do want to reiterate that we do a lot of educational content, typically 2 webinars a week, whether it's a solo webinar like I'm putting on today, or a webinar with an expert guest in a specific field of investing. You can find those typically on Tuesday and Thursdays each week from 12 noon Eastern to about 1 or so Eastern time, depending on the amount of content we're covering and the amount of questions that come in from our live participants. They all also go onto our video library and get emailed out to everyone that signs up for the webinar. And we have a blog as well if you're interested in industry standard news. And getting started with Advanta is a really easy process. We have an application that's only about 7 or 8 pages. It takes you most of the time 10 to 15 minutes to complete. I can jump on a call or a Zoom session and help you through the entire application packet if you need it. And then once your account's open, we pair you with a client account manager that answers all your questions and helps you with your investment strategies to get things done as smooth and simple as possible. In most cases, we can get investment transaction funded within 1 to 2 business days of letting your account manager know and providing the investment documentation to do the transaction. It's easy to fund your account, as I went over earlier. Usually there's no tax consequence. The money moves pretty quickly and pretty simply from your previous account to the self-direct account. And you can start investing almost immediately. There is an IRS rule where you have to wait 7 days from the day your account's open. So if you're looking at a tight time frame investment, it's better to get started now and get your account open so you can clear those 7 days that the IRS mandates and typically get your investment funded within the first 10 to 14 days on average. Can be quicker, can be at that 7th day. Could take a little bit longer depending on the investment paperwork and who you're investing with, but we're here to help make that a very smooth process for you as the account holder. And finally, I will wrap up here with this slide of my contact information again. If you are interested in any specific topics, questions, more educational content, or getting started with an account, please feel free to reach out to me. I'm very happy to help however I can. I really do have a passion and enjoy providing education from a financial standpoint. Financial literacy is something I've always had a passion for. I've been taking accounting related classes and working in the finance industry really since 10th grade. And it's something I really love and enjoy helping people just get a better understanding, a better knowledge, and prepare themselves better for their future, for retirement, and just have a better grasp of what you can and cannot do with your money. So having said that, I hope you've all enjoyed this content. Please feel free to check us out for anything else, come back for more, and I look forward to working with you and networking with you in the future. Have a great rest of your day, and we'll see you next time.